Welcome to this video on example 7 in IAS 36. So this example can be found in the illustrative examples, and basically I'm going to be going through the example 7a, 7b and 7c, and we're going to be looking at how we do impairment testing of CGUs with Goodwill and non-controlling interests. Okay, now this video is it's effectively separated into the 3 parts because of the 3 videos, so it's going to be a bit lengthy, but pause it if you feel like you just need to take a break, or if you need to go over some principles, make sure to rewind it. If you have any questions, you can post a comment down below, and don't forget to like and subscribe to my channel. Okay, so let's get started. Okay, in the first example, we're looking at example 7a. Okay, so in example 7a, we're looking at non-controlling interest measured initially as a proportionate share of net identifiable assets. So we know that with NCI, we can measure our NCI either at their proportionate share of the net identifiable assets, or we can measure them at the fair value. Okay, so in this case, we're just going to look at the proportionate share first. Now, it's important to note that all of the tax effects are going to be ignored in all of these examples, right? We just want to isolate the impairment aspect, and obviously any tax issues will be dealt with later. Okay, so let's go through the background, and I hope that you have this example open so that we can read it together. Okay, so in example 7, it says that a parent acquires 80% interest in a subsidiary. Okay, so we've got the parent, and they have a subsidiary, and they own 80% of that subsidiary. Okay, so they have paid 2,100 currency units, and this was on the 1st of Jan X3. Okay, so at that date, the subsidiary's net identifiable assets had a fair value of 1,500 currency units. Okay, so the fair value of the net assets equals 1,500. Okay, the parent chooses to measure the NCI as a proportionate share. Okay, so let's just remind ourselves here, NCI equals proportionate share. Okay. So if the NCI then is measured at its proportional share, then we can actually go and calculate what that amount is. Okay, so we would take, in order to determine the amount of the NCI, okay, we can say that the NCI effectively is 20%. So we'll take 20% multiplied by the fair value of the net assets. That's 1,500. So that gives us 300. That is the value of the NCI. Okay, now that we have the value of the NCI, we can actually determine what the goodwill is, because remember, this is about impairment testing of the goodwill. So let's actually go and calculate the goodwill. Okay, so how do we calculate our goodwill? Okay, in order to calculate the goodwill, we say that the goodwill is, firstly, we're going to take the sum of the consideration and the NCI. So that's 2,100 plus the 300 NCI, and then from that, we're going to subtract the fair value of the identifiable net assets. Okay, and that is going to give us goodwill of 900. Okay. The question then tells us, if we go further, that the assets of the subsidiary together are the smallest group of assets that generate cash inflows that are largely independent of the cash inflows from other assets or groups of assets. So that means that this subsidiary is a cash generating unit. Okay, now because other cash generating units of the parent are expected to benefit as well from the synergies of this combination, the question tells us that goodwill of 500 relating to those synergies have been allocated to other CGUs. Okay, so of this 900, right, 500 has gone to other CGUs. Okay, which means that for this subsidiary, okay, this sub, which is a CGU, okay, we're dealing with goodwill of 400. Okay, so that's the goodwill that we're looking at over here. Okay. Now, because the cash generating units comprising subsidiary includes goodwill within the carrying amount, it has to be tested annually for impairment, or more frequently if there is an indication that it may be impaired. So let's go and look at paragraph 90, which further elaborates on this requirement. Okay, so let's unpack paragraph 90 in IAS 36. So in paragraph 90, it talks about a cash generating unit, okay, to which goodwill has been allocated, and it says that it shall be tested for impairment annually. And whenever there is an indication that the unit may be impaired, okay, so when there's an indication that the unit may be impaired. Okay, by comparing, so how do we do this? We do this by comparing the carrying amount of the unit, including the goodwill, with the recoverable amount of the unit. And this is really the same principle that you've learned from the first time you learned about impairments back in first year accounting. The only difference now is we're talking about a cash generating unit, right? So when we first learned about impairment, we were looking at individual assets, but now we're looking at cash generated units, and the principle is exactly the same. You're going to compare the carrying amount of the cash generating unit, including the goodwill, okay, and then you're going to repair it to the recoverable amount. And if the recoverable amount of the unit exceeds the carrying amount of the unit, then the goodwill allocated to that unit shall be regarded as impaired. Okay, so then you are going to impair the goodwill. If the carrying amount of the unit exceeds the recoverable amount of the unit, the entity shall recognize an impairment loss. Okay, so if the recoverable amount, okay, is less than our carrying amount, then we are going to have to impair it, and we need to recognize an impairment loss. And paragraph 104 gives a bit more detail about how that impairment loss is going to be recognized. Okay, now that we've gone through paragraph 90 and we've read that together, we can now continue with the question. So the question tells us that at the end of X3, okay, at the end of the year, the parent determines that the recoverable amount of the CGU, which is the subsidiary, equals 1,000, okay? The carrying amount of the net assets of the subsidiary, excluding the goodwill, is 1,350. Okay, so this is the recoverable amount of the whole CGU, and then the carrying amount, okay, of the net assets, okay, which exclude goodwill, that equals 1,350. Okay, so now what we need to do is we need to test this subsidiary for impairment. Okay, and the way that we do the testing for impairment, firstly, is we've got to figure out, well, what is the carrying amount of this subsidiary, right? Not just looking at the net identifiable assets, but also including the goodwill. And we've got to bear in mind that the goodwill in this case was calculated with our subsidiary without NCI being measured at the proportionate share of the net assets. So that means that effectively what we're going to have to do for our goodwill is we're going to have to gross our goodwill up to get to a goodwill figure that accounts for the subsidiaries, for the NCI portion as well. Okay, so let's just do our little schedule. So we're going to start here on top with our goodwill of the sub. Okay, and then we're going to look at the net identifiable assets. Okay, and then we're going to have this total column. Okay, now, our starting point for our carrying amount, is with the goodwill. We know up here we calculated the goodwill, so it was up here. Okay, there we calculated the goodwill to be 400. Then we were told that the carrying amount of the net identifiable assets was the 1350. So that means that the carrying amount as it stands is 1750. Okay, now we need to account for the goodwill that would be attributed to the 20% of the non-controlling interest in the subsidiary, okay, at the acquisition date. And the way that we do this is we basically gross up our goodwill. Okay, so I'm just going to do the little calculation over here. Okay, so if our goodwill, okay, if we're going to gross up our goodwill, the way we do that is we take the goodwill, which is 400, and we're going to multiply it by a ratio. Now we're looking for the goodwill that is attributed to the 20% NCI. So the ratio, the figure we're looking for is 20%. Okay, but what figure have we been given? We've been given goodwill, the 400, which relates to 80%, right? Relates to the parent. So that's going to be over 80. So therefore it means that the unrecognized goodwill attributed to the NCI is actually 100. Okay, so now we can go and put that over here. Okay, we can say this is our unrecognized NCI, and that is goodwill of 100. Okay, then once we've done the gross up, we now have our adjusted carrying amount, and our adjusted carrying amount is goodwill of 500, net assets of 1350. So that gives us a total of 1850. Okay, that is our adjusted carrying amount, and this amount we now have to compare to the recoverable amount. So our recoverable amount, which was given, was 1000. Okay, so that means that we have an impairment loss of 850. Okay, so this is the impairment loss that we have calculated over here. Okay, now that's only the first step. Okay, because even though we've calculated the impairment loss, now we actually have to allocate the impairment loss. Okay, and in terms of allocating the impairment loss, we allocate it in accordance with paragraph 104. So let's go and read paragraph 104 to understand that. Okay, we also are going to refer to paragraph C6 of Appendix C in IAS 36 so that we can understand how to allocate the impairment loss. Now, in terms of paragraph 104, it says that an impairment loss shall be recognized for a cash-generating unit, and that is the smallest group of cash-generating units to which goodwill or a corporate asset has been allocated, if and only if, okay, the recoverable amount of the unit or groups of units is less than the carrying amount. The impairment loss shall be allocated to reduce the carrying amount of the assets of the unit in the following order. Okay, so when we impair the asset, there's really two steps we need to go through in order to allocate the impairment loss. Okay, so first of all, we're going to reduce the carrying amount of any goodwill allocated to the the units. So if our recoverable amount, right, is less than the goodwill, then it means that we're just going to be reducing the goodwill. The impairment loss. But if that impairment loss is greater than the goodwill, then we need to reduce all of the goodwill, but there's a second step we need to take on. And that second step is that we are then to allocate it to other assets of the units on a pro rata basis of the carrying amount in each group of units. So we're going to look at the assets within the CGU, and we're going to allocate it on a pro rata basis to make sure that we are spreading that impairment loss appropriately. Okay, these reductions in carrying amount shall be treated as impairment losses on individual assets and recognized in accordance with paragraph 16. Okay, so that's the overall principle when we are allocating the impairment loss. Now let's look at what Appendix C, so paragraph C6 says in terms of the when we're impairing, when we're looking at a subsidiary where there is NCI. Okay, so it says if a subsidiary or part of a subsidiary with a non-controlling interest is itself a cash generating unit, the impairment loss is allocated between the parent and the non-controlling interest on the same basis as that which the profit or loss is allocated. So what that's saying is that when you do your profit attribution, when you do your statement of comprehensive income profit attribution for the parent equity holders and the NCI, it's saying that if the subsidiary is a CGI and there's an impairment loss, CGI, and there's an impairment loss, then you're going to, essentially the NCI is going to share in that impairment loss as well. So you're going to attribute a portion of that impairment loss both to the parent equity holders and the non-controlling interest, and you're going to attribute it based on the profit attribution ratio that you're using. Okay, now that we've read those paragraphs, okay, we can actually go and allocate our impairment loss. So we have an impairment loss of 850. Okay, and we have to allocate it first to our goodwill and then to our net assets. Okay, so we have in the CGU, we have goodwill that we've recognized of 400. Remember this 100 here, this is unrecognized. So the goodwill that we've recognized is 400. So that means that the in terms of our impairment loss, right, we have the 850 impairment loss. So of this 850, the 400 gets allocated to the goodwill. So that means that the impairment loss is effectively going to take out all of the goodwill, such that the carrying amount now for our goodwill is going to be 0. Okay, it's going to be 0 after we've allocated it. However, we still have 350 of that goodwill that needs to be allocated, and that goodwill must then be allocated to the other assets in the CGU, which in this case is the subsidiary. Okay, so the way we're going to allocate that 350 is we're going to look at we're going to do it on a pro rata basis, looking at the underlying assets, and we would prorate that 350 to each of the underlying assets, and that is how we would impair our goodwill when there is when there's NCI that has been measured at the proportionate share of the identifiable assets. Also remember that this impairment, of course, will be attributed between both the parent and the subsidiary. Now, in our next example, which is example 7b, we're going to look at the non-controlling interests that have been measured at fair value. Okay, so we have NCI at fair value. Okay, and in this case, like example 7a, the subsidiary is a standalone CGU. Okay, so the information in this question is pretty much the same as in 7b with a few tweaks. So the first thing that's different is that in this question, okay, we have that the fair value of the NCI equals let me just see, it's the number, the fair value of the NCI is 350. Okay, so if the fair value of the NCI is 350, then that means that we need to now recalculate our goodwill. Okay, so if we do our goodwill calculation over here, we've got goodwill of 2,100, which was the consideration. Then we're going to add the fair value of the NCI, which is the 350, which we've been given, and we're going to subtract the fair value of the net identifiable assets at the acquisition date, which is 1,500, and that gives us a goodwill of 950. Okay, and again in this question, we're told that of this goodwill, 500 is being allocated to the parent because of synergies that are expected to happen at another level. So in terms of this question, we're only looking at goodwill of 450 that potentially needs to be impaired. Okay, now when we're testing for impairment, we are told that at the end of 20x3, okay, so at the end of 20x3, the parent determines that the recoverable amount of the CGU is 1650. Okay, and the net assets, it's the same, it's 1350 as it was previously. So how do we then determine the impairment loss to be recognized? Okay, so firstly, we're going to say, well, what is the carrying amount? Okay, so the carrying amount in this case is firstly, it's the goodwill, which is 450, which we've calculated, plus the net identifiable assets, and that is 1350. So that gives us a carrying amount for the CGU of 1,800. Okay, now we are told that the recoverable amount is 1650. So therefore, we have an impairment loss, okay, of 150. And the question is, how do we then allocate this impairment loss? Well, again, in terms of paragraph 104, we're going to first allocate it to the goodwill and then to the other assets in the cash generating unit. Now, in this case, the goodwill is 450 and there's only an impairment loss of 150. So the full 150 is going to be allocated to goodwill, and we won't need to do an attribution to any other assets because we still have goodwill remaining. In fact, after this, the goodwill would have a carrying amount of 300 because that's the 450 minus the 150. And we must also remember then that this 150 must be attributed based on the profit attribution ratio to both the parent equity holders as well as the NCI. So the NCI must share in this impairment loss because it originated at a subsidiary level. Okay, now moving on to example 7c. And in example 7c, we're looking at non-controlling interests that are measured initially at fair value and the related subsidiary is part of a larger CGU. Now, this is different from 7a and 7b, where the subsidiary was a CGU on its own. Now we're saying that this subsidiary actually forms part of a larger CGU. So let's read the background information together. So it says, suppose that for the business combination described in example 7b, so the previous example, the assets of the subsidiary will generate inflows together with other assets of the group of assets of parent. Therefore, rather than the subsidiary being a cash generating unit for the purposes of impairment testing, the subsidiary becomes part of a larger cash generating unit, Z. Okay, so in this case, our CGU, we're going to call it Z, and this includes the subsidiary that we are dealing with. Okay, other cash generating units of the parent are also expected to benefit from the synergies of the combination. Therefore, goodwill allocated to those synergies in the amount of 500 has been allocated to other cash generating units. Okay, so we've allocated out 500, okay, of the goodwill to the parent. Okay, now it tells us that Z's goodwill related to previous business combination is 800. So if we look at Z's goodwill, okay, it equals 800, and this is related to a previous business combination. Now, because Z includes goodwill within its carrying amount, both from the subsidiary and from the previous business combination, it must be tested for impairment annually or frequently if there's an indication that it might be impaired. So again, here we're dealing with the principle outlined in paragraph 90, and if you just want to refresh your memory, you can skip back to paragraph 90. Okay, now, how do we go about testing for impairment? So at the end of 20x3, the parent determines that the recoverable amount of the CGU Z, so the recoverable amount of Z equals 3,300. Okay, and the carrying amount of the net assets, so the carrying amount of the net assets, okay, excluding the goodwill, is 2250. Okay, so in terms of our impairment testing then, okay, let's think about what needs to happen. Okay, so if we consider our carrying amount, and now we've got to think about our goodwill and our net identifiable assets. Okay, so what is our carrying amount of our goodwill, right? Well, the goodwill sitting in Z related to previous business combinations is 800, but the goodwill of the subsidiary, which is now included in this cash generating unit, also needs to be brought in. Now, if you remember from the previous example, we calculated a total goodwill of 950, but like the previous example, we were told that 500 is allocated to the parent, so it's actually this 450 that we need to bring in as well. So we're going to bring in the 450 over here. Okay, so that is going to give us goodwill of 1250. Then the net identifiable assets is 2250, so that gives us a total carrying amount of 3500. Okay, we're told that the recoverable amount now is 3300. Okay, you can see the recoverable amount, so that means that we have an impairment loss, okay, of 200 if we subtract the one from the other. Okay, now in accordance with paragraph 104, okay, skip back to paragraph 104 if you need a little refresher. Okay, the impairment loss, okay, of 200 must be allocated in the unit by first reducing the carrying amount of the goodwill. Okay, so we first have to reduce the full amount of the goodwill. Okay, however, with regards to the goodwill of this whole CGU, we've got goodwill for Z from the previous business combination, and we've got goodwill coming from the subsidiary. So we actually need to look at paragraph C7 of Appendix C to see how we are going to attribute this goodwill. So let's read that paragraph together. Now let's look at paragraph C7. So C7 says that if a subsidiary or part of a subsidiary with a non-controlling interest is part of a larger cash generating unit. Okay, goodwill impairment losses are allocated to the parts of the cash generating unit that have a non-controlling interest and the parts that do not. Okay, so you're going to allocate it to both parts. Now, the paragraph goes on to say the impairment losses should be allocated to the parts of the cash generating unit on the basis of. Okay, so firstly, to the extent that the impairment relates to goodwill in the cash generating unit, the relative carrying values of the goodwill of the parts before the impairment. Okay, so you're first going to allocate to the goodwill, and then to the extent that the impairment relates to identifiable assets in the CGU, the relative carrying values of the net identifiable assets of the parts before the impairment, and as such any such impairment is allocated to the assets on the parts of each unit pro rata on the basis of the carrying amount of each asset in that part. So again, we see that the similar principles, even from C6 is coming through, from paragraph 104, right? We're first actually going to allocate to the goodwill. So we first look at impairing the goodwill, and thereafter we're going to move over to the assets. But let's look at the practical example to see how we actually apply this paragraph. Okay, so in line with the principles with paragraph C, if the partially owned subsidiary, right, forms part of a larger CGU, in this case, which is Z, then the goodwill impairment loss would be allocated first to the parts of the cash generating unit Z, and then to the controlling and non-controlling interest of the partially owned subsidiary. Okay, so what does that mean? It means that the parent is going to allocate the impairment loss to parts of the CGU on the basis of the relative carrying amounts of the goodwill of the parts before the impairment. So in this case, right, the subsidiary, if we think about the subsidiary, right, the subsidiary had goodwill of 450 out of a total of goodwill of 1250. So that means that the subsidiary is going to have 36% of the impairment allocated to it, right? So we're going to allocate 36% of this impairment loss to the subsidiary. And then the impairment loss will also be allocated to the parent equity holders as well as the NCI. So there's really two levels, okay? First, we're going to separate the impairment loss, and we're going to split it between the subsidiary and in Z, okay? So 36% of this is going to go to the subsidiary, and the remaining will go to Z's goodwill. And then within the subsidiary, we're going to then, when we're doing our profit attribution to the parent equity holders and the NCI, we're going to take into account this impairment. Okay, that was a lot of information to go through, and I hope that this example was useful for you. If you have any questions, please post them below. If you want to revise anything, make sure you go through this video again. Don't forget to give this content a like and subscribe to my channel if you haven't done so, so that you are updated as to any new videos that I post. Thank you so much for watching, and I will see you in the next video.